something a little different. I got this new writing tablet, so I'm going to try to kind of do like some lessons, I guess, on this writing tablet, opposed to looking at the charts. It's easier for me to kind of write out my thoughts whenever I'm trying to explain something. So in this video, I wanted to look at timing, and my handwriting is pretty bad, so it's not this writing tool that's making my handwriting look bad, it's just bad in general. So timing trend reversals. The first thing that we want to look for in timing a trend reversal, and I'll just kind of give an example out here to the side. You have something that trends up, goes down, trends up, goes way up, down, and then you do something like this, and then you have a reversal here. And so what we're trying to figure out is how do we time this bigger reversal here for a bigger pullback, and how do we time these little ones? So these little ones in here, what tools can we use, indicators or tools can we use to try to time these to take short scalps on? So the first thing that I look for is a divergence. And so a divergence is basically, you can use multiple different indicators. I use the RSI. I know people use MACD to look for divergences. I mean, you can look, I don't know what all other indicators there are, but there are many other indicators that can display divergences for you. RSI is the one that I tend to use. And so if you followed me on Discord, you see where I have RSI in there a lot when I'm looking for divergences. And so the two different kind of divergences that we're looking for is, we have a bullish divergence, which I'll do in green since it's bullish. And so a bullish divergence is when the price is trending down and we make a low and a lower low in price. And then the RSI, if you were to find the RSI for this pattern, would look like a low and then a higher low. So you end up with something like that, where it's trending up, where the price is trending down. So you get this divergence. So where the strength looks like it's starting to pick up and the price is running out of steam, basically in this downtrend, before a move higher. And so that's what you're trying to time, and that's what you're looking for. And so most of these circumstances right here are going to have that on one of the time frames. Time frames that I like to look for are 5-minute and 15-minute time frames. That's typically what I like to look for any divergence, whether it's bullish or bearish. And so the bearish divergence is going to look like this. The bearish divergence is an uptrend where you're running out of steam on the final push higher. So you make a high and a higher high, and then the RSI makes a high and then a lower high before rolling over, and it's downtrending, so you make a high and a lower high. And that's just telling you that the trend's running out of strength because the RSI is starting to trend down while the price is making a higher high, and it's indicating that we have a short-term reversal potentially on our hands. It doesn't have to always occur. You can always pull back and then continue to make another higher high, so you end up with a triple divergence where the RSI comes back up again to here. Whoops, let me get rid of that. So the RSI would come back up again to like right here if this was to make one more higher high, and you'd end up with a triple divergence. The same thing can happen on the bullish case here. So that is possible for that to happen, but typically what you're looking for is, for once you get the first divergence, that you're going to have some kind of pullback that you can capitalize on. So the divergence is the first thing that I'm looking for. The second thing that I'm looking for is confluence. So when I talk about confluence, I'm talking about where are likely reversal levels. When you have a trend, where is it going to likely catch support and or resistance? So if you're in a downtrend, where could it catch support? If you're in an uptrend, where can it catch resistance? So you're looking for those confluence levels. What I like to look for are fib levels. Fib levels offer good support and resistance, and they get respected quite well, especially for scalps. So that's what we're going to focus on here. So what I'll do is just draw another fake trend here just to illustrate the example that I'm trying to make. So here, if we look at this example, what we have is and you'll get better and better at this as you get used to using this method here. But since we're looking at fib levels, what you need for fib levels are pivots. You have to know where you want to pull your pivots from. And so in this case, we have a pivot high and we have a pivot low. So it's obvious, once this forms, we have a pivot high. And so once we start breaking down here, we know that this is a pivot high. Once this starts to react, maybe after we get this second wave going up, we know this is a pivot low. So what we're doing is we're pulling a fib retrace from this pivot high to the absolute high of that, to the wick high, down to the wick of this low. And what it'll do for you is it'll give you fib levels. And so a 50% retrace of this move down right here would probably be, somewhere right in here. And so that would give you your 0.5 fib level, and then the 61.8% retrace up right here of that move down would be somewhere probably right in here. So these are the two most important fib levels, and the reason they are the most important, at least from what I was taught and what makes sense to me just from seeing it work over and over and over again, is what happens at these fib levels are algorithms kick in. I don't know if they, they're the big wells or that make the market, but for some reason, or it's just a bunch of individual people that use these levels. For whatever reason, they get defended very well, the 618 and the 0.5. As long as you denote your pivot high and your pivot low correctly and you pull your fib levels correctly, you can just about bet that the 0.5 or 618 is going to give you a reaction. And a lot of times the actual reversal will happen at those levels too. So it's good to be aware of those when you're looking for confluence. So if you notice, we have a bearish divergence here. Between these two levels right here is what you'd be looking for. So you have a high and you have a higher high right here between these 2 points. So if you were looking at the RSI, it would look something like this. For that section right there, it would look something like that, where you made a high but then you made a lower high on the RSI. So you're running out of steam, but you're making a higher high. You're also running out of steam and making a higher high into an important fib level based on this internal retrace right here. So that gives you confluence in this zone right here. So if you're looking for a high probability zone, you would be looking for that zone right there, because you have a divergence, which was step one, and you know you're hitting a confluent area where algorithms would normally kick in and give you a reversal. So that gives you two things that are stacked into your favor for this trade. And so what I would normally do in this case is obviously the fib levels that you want to look for are the 0.5 and the 618, between those two regions. Recently, I've noticed that the 707 gets respected quite well too. So the 707 would be a little bit higher than the 618. It would be right in here somewhere. So the 707 might be like right here. For whatever reason, that's been respected more and more lately. What will happen is you'll get this divergence, but a wick will come up and tap. So you'll have a wick come up and tap this zone right here and then reverse. And so I've noticed that happen a lot more recently. And so it doesn't really affect you as long as you have a stop loss placed in an appropriate level. And so what I've done in the past, and I'm just going to go ahead and draw another fib level on here. I'm going to make sure I have all the fib levels. So when you pull your fib retrace, it's going to look something like this. You get all your fib levels here. So 786. And so what I've done in the past is I've looked at a sample of 100 of these setups. Maybe not quite 100, I don't know. But what I found in that sample, if you do a normal distribution, what you get is a average. If this is a frequency right here, this is the frequency of trades, and this bell curve will show you where the frequency is high in relation to what fib level. So if you drew a bell curve, it would look something like that, where it gets very high and then it drops off and it tapers off very low. So the highest frequency of reversals happen between the 0.5 and the 618, because you can see frequency goes up as you approach these 0.5, 618, and it goes down. It becomes it becomes even less likely the higher up that you go in an internal retrace. And that makes sense, because if you're retracing this move back up, it becomes less and less and less likely that you're going to reverse back down if you're bullish enough to retrace most of the sell-off right here, because bearish trends normally will not get above the 0.5 to 618. You might even get a wick up to the 707, like I was saying, but normally if it's going to remain a bearish trend and you're trying to catch the reversal on a pullback, then it would hold between the 0.5 and 618 a high majority of the time. So that's what I found when I looked at those setups, and those it might have not been 100, it might have been like 50, I can't remember, but it was very obvious that you want to be getting in somewhere between the 0.5 and 618, or not blindly getting in, but looking to get in at that area. So you look for other things to happen, like this divergence, and you also look for it approaching these high probability fib levels for rejection or reversal. What I've seen is that the frequency is very low when you approach the 707 and 786 up here. So what I typically do is I set my stop loss above the 786 up here. So my stop loss would be right up above the 786. And so if I'm lucky enough to get an entry either at the 618 or maybe between the 0.5 and 618, then I would have a decent risk to reward if I was going to be targeting this pivot low, or even a breach of these pivot lows and a continuation of the trend. I would have at least a 1-to-1 risk to reward in most cases. And so that's a good setup that I'm looking for right there, and how I would use fib levels as confluence. And I can show an example of these when we go to the real charts in just a second. And so this was the bearish case, so I'll do this in red. And the bullish case, or this bullish scenario that would play out just like that. So the bullish scenario would look like this. And so in this case, we're looking for a, obviously we have a pivot low, pivot high. We're pulling a fib retrace from the absolute pivot low, the wick of this low, to the wick of that high. And we're looking at where a potential reversal would be. And we have a 0.5 right here. The 618 would be a little bit lower than that. In this case, we have a bullish divergence between these. We have a low and a lower low in price as we're approaching the 0.5. So we have this hot zone right here of support in this zone right here. And if you're looking at this on the RSI, it would look like this, where we make a low and a higher low. So it just shows that the strength is running out on the trend as we're approaching a confluent level of support, which would be the 0.5 or 618. This can always crash down with a wick down to the 618 before you get the reversal, so you have to be prepared for that, while the divergence would still be intact. And so we would have the 786 down here, and in this case, your stop loss would be right below the 786. So that would be your stop loss. Your entry in this case would have most likely been at the 0.5, so you'd had your entry right here. And then you could, you have a decent risk to reward if you're targeting this prior high, or you're targeting much higher levels in case this is going to be a trend continuation or an actual bigger reversal. So if this was coming off a downtrend and you had the first pullback and then you had the first reaction up and then you're buying the pullback, then this could be a beginning of a much bigger trend until you're getting in at a confluent level where you have divergence and you're also approaching important fib levels. And so that would be my setup there that I'm looking for. Now, the third thing that I want to talk about is the third thing that I would look for anyway is structure. So structure, and when I'm looking at structures, I'm really looking at false breakouts. So if anybody's been in the Discord, they've seen where I've shared a lot of examples of false breakouts. And so we'll take an example kind of similar to what we were just looking at just a second ago. So you have like a high, you have this like trend down, and then we're coming up like this for a reversal, and then we do something like this. What we're looking at here is we have the exact same thing that we were just looking at, where we have the we have this pivot, and this would be a bearish scenario obviously because we're internally retracing a downtrend before possible continuation. So in this case, you have the pivot high, you have the pivot low, but in this case the structure even gives you a little bit more to work with here. You have a channel that you're in here. So if you look at this support and resistance, you notice how you have a channel that the price is kind of staying in. And what happens is on this last leg up between these 2 points right here, you have a high and a higher high, and you get your bearish divergence where you make a high and a lower high. So the trend's running out of steam. You've also come up and you've hit a let's just say the 0.5 right here. So you've also hit the 0.5 fib of that move down. And so what happens is once that happens, you get a rejection, and once it comes back within this channel right here, this channel that it broke out of, and becomes a false breakout. So at the point that it falls back into that channel right here is the point where I would be looking to enter. And at that point, what I could do is, you know how we would normally have our stop loss up here at the 786. I would normally have my stop loss up here. But since we have this structure, we have all this confluence right here, and we reject and we fall back within that structure. What that tells me is that this bullish structure has not played out, and there's going to be a lot of people getting out of their long positions that bought this breakout. And what it'll do is force price down, and when it forces price down, then some other people start to think that it's just a reversal of this internal retrace, and then you get like a continuation deeper. And so that's why whenever I enter at this point right here, if my entry is right there, then what I would do is I would move my stop loss actually to right above this higher high right here. That would be my new stop loss level. And so as you can see, you tighten up the distance between your entry and stop loss considerably, because you've moved it from above the 786 to now right above this pivot high. So that allows you to have an even better risk to reward. So if you're looking at this as a risk to reward, if you're looking at the distance between the entry and the old stop loss right here, that distance could be, let's just say in price it's like 1%, but the distance between this new stop loss is where this new stop loss is placed right here might only be like 1/4%. So instead of needing a 1% move down for a one-to-one risk to reward, so like in this case we would need an equal move down to get 1%, so that would give us a 1-to-1 using our old stop loss distance. Now we only need a 1/4% move down for 1-to-1, and if we targeted the same area that we would have targeted with our previous stop loss distance, we actually end up with we actually end up with, you know, another 7.75% move, and our initial risk is 0.25. So we're making, if we target that initial area that we needed to target based on that stop loss, we're actually making a 4-to-1 reward to risk ratio in that case, versus a 1-to-1 that we would have had with our original stop loss placement up here. And so it gives you a much better risk to reward because you're able to manage your stop loss distance from entry a lot tighter. And so these scenarios right here are very, very profitable. When you can see everything line up like this, you have the divergence, you have the fib level confluence that you get a rejection off of back into a structure that should have been a breakout level and gathered support, then you can enter with confidence with your stop loss a lot tighter. It gives you a much better risk to reward. In this case, our risk to reward is 4 times better than what it would have been with our stop loss up above the 786. And so that's what I would like you guys to look for in the charts. You know, these don't happen every day, obviously, you know, but when they do happen, you can have confidence in them. And so this is the kind of strategies that I look for. It's, you know, not all reversals are the same, but most reversals share some of these qualities. And so these are the qualities that I would be looking for high confidence and high probability setups. So let's go over to the chart and see if we can find some examples here. Alright guys, here's one example right here. I'm going to give you a second to see if you see it. So if you're looking at this move down and this move up, let me know what you see. Because what I see is a pivot high, a pivot low, and I see an internal retrace of that move down. And then I also see what looks to be like a channel that we formed coming up into that retrace. So I'm going to go ahead and pull my fib retrace from that top to the absolute pivot low. You're going to the wicks. You always want to use the wicks. And so when I do that, you can see we've got resistance at the 0.5. I'm also going to put the RSI on here so we can look for divergences. So relative strength index. So we've channeled. We've got a channel coming up. And what we did is, you can see between this high and that high, we made a higher high in RSI. So there's no divergence. But between this high, between that high right there, I'm going to make that red so we know it's a divergence. Between those two highs, we made a higher high, but the RSI actually made a lower high, if you look at it. So what that is a perfect bearish divergence. We're already between the 0.5 and the 618. So what we could have done is, what I would do in this scenario is, I probably wouldn't be getting in until we had a bearish candle close. And so as you can see right here, that first bearish candle right there where it engulfed that previous candle, that would have been an area I could have entered on a short. And so if I would have got in right there on that low, I'm using this risk to reward tool from the previous video, I could have had my stop above the 786, and then I would have been targeting, could have targeted the pivot low, or I could targeted a trend continuation. Sometimes the negative 236, if you add that onto your fib retrace tool, a lot of times 0.5 to 618 holds. A lot of these algorithms are targeting that negative 236, so that's a good target as well. You know, in this case, obviously, this was a very bearish reversal. So you could have hit much lower targets if you had like a trailing stop. But what I want to show here is that you can tighten this stop loss up significantly. There's no point in having your stop loss way up here if you have signs that the top is in right here. If you have this divergence, we're in the high probability zone right here between these fib levels. You have a reversal candle that's printed here, so why not tighten the stop up to right above the pivot high? That gives you a much better risk to reward. You don't have to target very low at all to get a 1-to-1 now. A 1-to-1 risk to reward would only be right here. You only have to be right 50% of the time for that. And then, you know, obviously if you're targeting the pivot low, you're getting like an insane risk to reward. I mean, 6-to-1, that's That's very good. You don't have to be right often at all. I mean, maybe 15% of the time or something like that for a 6 to 1. And so, and then the other thing that we have going on right here is this channel. So we didn't get a false breakout out of the top of this channel, but we did get a breakdown out of the bottom and a retest. So once this retest forms, and then we have this follow through right here, at that point, I mean, you could tighten your stop loss up even more, because now you have even more confluence that we've topped out. It tried to get above this 0.5 again, couldn't do it. Tried getting back in this channel, couldn't do it. We had this strong rejection on that candle. You could tighten your stop up even more. It's all about managing risk and trying to find these scenarios where you have all this confluence that allows you to manage your stop loss super tight. That's really the name of the game when it comes to trading. It's all about managing your risk. So the tighter stop loss you can get, the better. That also means that you can use higher position sizes. Because if you watch my previous video on position sizing and this risk reward tool, the tighter your stop, the bigger positions you can use, because it's a smaller percentage loss. So your position sizes can be bigger to still give you whatever risk per trade that you're going for. So this is one setup that I would that played out very, very well here. So let me just get rid of this and let's go over to another setup. And you know, this you don't have to look for major swings for this to work. You know, it can work on these smaller swings as well. Let's just look at a swing kind of like this right here. This is a bullish example. So we have a downtrend, we have a uptrend, which in this case you can see, let me just do this for an example real quick. You can see that this one didn't reverse, but we did get a reaction. You know, like this moved down, it came up, we did get a reaction at the 618. So you know, it wasn't ideal. And what happened there, and this even has a channel to go with it right here. So this one would have met all the criteria. And so even though this one didn't continue its trend down even to the pivot low or this negative 236 or lower, what it allowed you to be able to do is, let's see if we got the divergence. Okay, so we didn't have the divergence. We couldn't say that we also had a divergence to go with this. So between that high and that higher high, we didn't check all the boxes because we made a higher high in RSI as well. So we didn't check all the boxes for this to be a reversal and for it to continue lower, but we still even got a reversal. So like, even though we didn't check that box, if you were to use this criteria and get in on the close back in this channel after we've rejected off of 618 on an internal retrace, what you could have done is got in on the first close within that channel. So on that red candle there where we closed back in the channel, put your stop above the pivot high right here where we had the false breakout, and then even if you did a 1-to-1 risk to reward here, you would have hit profit. So it came down, if you were to catch the absolute bottom, was a 1.5-to-1 risk to reward. So even 1-to-1, which is good, because this strategy is going to work more than 50% of the time. For that risk to reward, you have to be right more than 50% of the time. With my experience, it works more than 50% of the time. So even with this 1-to-1, you have a really nice scalp opportunity here, even though this trend didn't continue to lower levels. And so it comes down to, you know, this one didn't meet all the criteria, so maybe I don't target lower levels. Maybe I go for a smaller risk to reward. So let's go to another example here. And like, you know, not every internal retrace is going to give you all of the ingredients for it to be a really good trade, like I was saying earlier. But you know, most of the time, if it does meet all those requirements, you're going to do pretty well. And so this is another example where we went long. So what I'm doing is pulling from the absolute pivot low, absolute pivot high, and we're internally retracing right here down this move up. And what happens is we have a channel here too, depending on how you want to draw the trend lines. But normally, whenever you're in a correction, the correction normally channels. Corrections are normally have some kind of structure with them, whether it's a parallel channel like that, or a falling wedge. You know, falling wedge structures are typical. You can even get expanding. You can even get expanding falling structures like that too, which aren't as common. The most common are definitely either a parallel channel like that or a falling wedge, where if you're getting a move down, it'll break out the bottom before it reverses. And the same way here, if this one's coming down, it'll break out the bottom before it reverses. And so you end up with something like that. And then, it's just the exact opposite in when you're looking for a reversal, a bearish reversal, it would be just the opposite of that. So in this case, you can see we poked through, we came through the 0.5, we're in this zone right here, which is where, when we're looking at that normal distribution earlier, where I looked at all these setups, high probability, the highest frequency of reversal is going to take place in this zone because of these algorithms. And so when you get that first bullish candle close back inside this channel right here, coming out of this zone, that's where you would look to get in. And so you would get in right here, and you could set your stop down below that pivot low. Or if you don't feel comfortable with that, because this really wasn't that bullish of a candle closing back in here, if you don't feel comfortable with how close that is, you could still go below maybe the 618 or something like that. But if if you're gambling on this actually continuing, and that was actually a reversal candle there, keep your stop very tight. And then you don't need a very big move at all for a 1-to-1. See how we're at 1-to-1 here? It's a very, very small move. And when it closes back in the channel, most of the time you can expect for it to gravitate to the other end of the channel. And if it's going to be a reversal, you've just got almost, you just got a crazy risk to reward. I mean, targeting the pivot high, you're at 6-to-1. Targeting negative 236, you're at like 9.5-to-1. And then if you had a trailing stop on this thing, I mean, that's a trade. 18 risk to reward. I mean, that trade right there makes your month, if not your quarter, if you're a trader. I mean, that's very, very good. So if you're risking 1% per trade, if you have an 18.25 risk to reward in this case, if you actually let it run all the way up there, then that's 18%. If you're risking 1% a trade, you just made 18.5% on that trade. And if we just held it to pivot high, you made 6.3% on that trade. That makes your month if you're a day trader. So these are the kind of trades that I look for. You look for all these ingredients. Obviously, this one also didn't have the divergence. If you look from the most recent little pivot low there to that pivot low, we still made a lower low in RSI as well. So we didn't get the bullish divergence, but we did meet the other criteria. And so you don't always meet all three. When you do meet all three, then you can really get behind it. In this case, we didn't meet all three, so maybe you don't risk as much. Maybe instead of risking 1%, you risk 0.5% because you didn't meet all the criteria. A lot of different ways that you can manage your risk with a good rule set that you have. And so it's best to just track all these trades and get comfortable with how you trade them. But these are just some good guidelines that I look for reversals. So let's see if we can find one more example, and then I'll be done. Alright, so on this one, I just want to show that it works on the higher time frames as well. We're on the 4-hour here. So we have a move down, internal retrace up. We have structure that we can put on this, depending on how you want to draw it on the wicks here. We did have a little scam wick right there. We can draw it on that wick as well. And so what we end up with is a channel. And in this case, we actually go through the 0.5, through the 618, and we wick the 707. So you can see where you had a potential here to get in once we rejected back down. But the thing is we didn't close back inside the channel here, and we also didn't have a between this high right here and that high before we got that little red candle. Between those two highs right there, we actually did not have a bearish divergence. We made a higher high in the RSI as well. So we didn't meet any of the criteria here. Well, we met the criteria that we hit the 618, but we didn't have a bearish divergence, and this red candle did not close back within this channel. So we would have not entered yet on that. our entry would have been once this broke down and we had that first candle. You see how that first candle right there closed back within inside this channel right here? At that point, we would have entered a short on that candle close, and we could have had our stop above this pivot high. Obviously, this is a pretty good move back up to the pivot high, so our risk to reward is not going to be the best, but even a 1-to-1 in this scenario is still not that far away. And like I said, once we go back in channels like this after we reject off a fib level on an internal retrace and we go back within the structure of the correction, it gravitates to this other end quite quickly. And in this case, it fell right through it and we went to the pivot low quite quickly. And we even continued. So if you had a trailing stop on this, you could have made a pretty good risk to reward on this trade as well. So I think that covers it for today. I hope this gives you something to look for. I mean, these are really, really good setups if you master them and you get good at figuring out where exactly you want to get in, how much you want to risk, and all that stuff. And so this is going to be the first video of me using this little writing tablet. Plan to make more in the future. I kind of like the way that I can express my ideas on it. So I will see you guys next time.